Hi everyone, John Sweet here, investment manager at Oakleaf Wealth Management. Welcome to our first quarterly investment review, which will hopefully be the first of many. The team and I decided after our videos earlier this year were very well received, we thought that we would try to start this on a sequential basis. And so if you have any suggestions, if this is helpful to you, if you think it is something that is meaningful, please let us know. If you feel there should be some changes or you'd like to hear something else, let us know. We'll take that under advisement. So let's get started. So let's start by taking a look back at the first 3 quarters of this year, and I will reference the first video that I released. I think it was a week or two into the new year. After 2 very strong years in the market, I was a little concerned about the valuations of especially tech stocks. 2.5 years earlier, we had a huge sell-off in tech stocks. This was right before AI. And so we had corrected that totally. And now I thought maybe things were a little rich. And in fact, in the first quarter, that corrected. The S&P was down 4.6. We actually had a 20% correction very quickly. We had one day where the markets went down by 10% and then back up by 10% a couple days later. So a very volatile first quarter. The second quarter, the S&P was up 11%. GDP in the first quarter was not great, but it started to get better. In fact, it was actually pretty strong in the second quarter. A portion of that could be attributed to inventory buying, with the idea that tariffs were coming and we needed to stockpile pre-tariffs. I think the third quarter can be characterized obviously by a good market, a healthy market. We ended up 7.8% as of a couple of days ago. But I think from an economic point of view, it's characterized by a moderating economy and some things we're looking at and some things you could call worries. So at the end of the quarter, we got some difficult prints on unemployment. And we look back now at some revisions that had happened, and it is reasonably clear now that employment is really stalled. We are really kind of running in place at this point in employment. And because of that, the Federal Reserve changed their forward guidance. They are now telling us they're going to be easing. Speculation is 1 or 2 cuts between now and the end of the year. And the markets did like that and responded. So that's kind of where we find ourselves right this moment, worried about the markets, happy about interest rates, looking at some valuations that are certainly on the loftier sides. Now, if we look at valuation, we can kind of, it is a tale of 2 cities, so to speak. You have the top 10 companies that are amongst the best corporations on the planet. They are printing money. They have lots of cash reserves. They are funding a huge AI buildup out of cash reserves, not borrowing it like we did in the 2000 era. This is being paid for up till now out of cash flow. That's a real positive. But these corporations are not inexpensive. So the market is assuming they are going to be continually higher with much higher profits. The other 490 companies are not priced as extraordinarily high as those 10 companies are. And in fact, they are trading at valuations something along the lines of 17 to 19, which is not wildly overvalued, nor certainly not undervalued. So what we're looking at here is potentially moderating economy, a very, very interesting opportunity in AI that we all know is going to change our world, and a market that we're not quite, we don't look at as a huge bargain, but we look out and say, wow, 5 to 10 years from now, we must be at much higher prices. So how do we think about that? I think that, as always, we need to reference our financial plan. We need to have a strategy. And that always entails long-term investing. This is a period where I think our job is to help you understand what your plan is, because I do believe that if you're a long-term investor, you're going to get rewarded. I don't know if it's in the next 12 months, 3 years, 5 years. I heard somebody say recently that they thought that AI was going to be like a mist. It was going to seep through all the corporations in the country and make them more efficient. I think that sounds reasonable to me. What time frame does that happen? I'm not sure. So we need to be prepared for some volatility coming up. That's where looking at your cash reserve and making sure if your cash reserve is low at this point, after 3 really good years, this would be a point where we'd be rebalancing and beefing up your cash reserve. I look out over the next year, and I do think there's a chance that we're going to be okay for the next 6 to 9 months. We have an election year coming up. That tends to be a period where the market has the wind at its back. We have very strong corporate profits. I've been in some meetings recently where companies like Goldman Sachs and Fidelity are looking forward and saying they feel very strongly that corporate profits are accelerating. That doesn't sound like the end of a market cycle, but one never knows. You just never know what's going to come out of left field. So the reason for this video is to give you a sense that we've got some positives in the market. We have some worries. Housing is one of those worries. Moderating employment is definitely a worry. We have lower interest rates, which is a positive. It will help the economy. As always, we have things to look at on both sides, and it always comes down to let's make sure if you have any questions about your financial plan or about your strategy or about your cash reserves that you give us a call. Please, again, give us feedback on this. I will be adapting this, trying to refine what I bring to everybody. I'm trying to make it within about a 5-minute time frame. I don't know if I just did that, but I'll get better. And let us know if there's something that you didn't hear that you'd like to, what that is. If enough people are asking for that, I will absolutely put that in. Thanks so much.